Hey, this is Warren Redlick. Tesla is over $600 a share as I'm speaking right now. Let's talk about short-term trading strategies, in particular, the idea of selling at the peak and buying at the dip. Before we get into it, I want to thank Bradford Ferguson of Halter Ferguson Financial and all my Patreon supporters. Now, let's talk about whether short-term trading strategies like buying at peaks and selling on dips makes sense. Keep in mind, this is not financial advice. I'm not a professional investment advisor. This is just my opinion. Are you ready? Let's go. So I follow Gary Black on Twitter. And Gary Black is a great guy to follow on Twitter. He says a lot of interesting stuff, but he definitely seems more like a short-term trading strategy kind of guy. And he's talking about a strategy here where he's saying you want to sell when it goes up to the indexers, and then at some point you would buy on a later dip. Notice when he describes his strategy, he doesn't say what his selling threshold is or when he would buy back in. What's the price level you would sell at, and what's the price level you would buy back in? I'm going to show you right now on some graphs how challenging this really is. This is a chart of Tesla's share price over roughly the past 90 days or 3 months. What you can see in the dream of the short-term trading strategies is you sell at the peak, which I have marked in red, and then you buy on the dip. This sounds good. The problem is that as you're going along into August and then it starts going up that mountain, how do you know when to sell? When you don't know when the peak is before you hit the peak. And if you're going to buy on the dip, you don't know where the dip is going to be. You don't know when the optimal time to buy on the dip is. So you can see it's great if you're able to pull this off. And I haven't sold a share. I did actually buy very close to that dip. I bought a few times in 2020, and one of my purchases was on that day at $343 a share. Even then, even though I bought on the right day, I didn't catch the right moment of the dip. The dip there is $330 a share. I paid $343 a share. I wasn't trying to play any games. I just decided I thought the stock was low and I had some free cash, so I bought some more. But I wasn't playing the short-term game of let me sell at this number and buy at this number. I just decided I had more cash to allocate, and this looked like a good time to buy Tesla stock. So here's a scenario where it could go badly, right? It's going up the mountain, and you decide, geez, you know what? I'm going to sell at 350. I think 350 is way above the 300 it was at, so I'm going to take my profits now, and then I'll buy in on a later dip. And then it goes up much higher than you expected. It reaches 500, so all of a sudden you feel stupid that you sold at 350. You could have held to 500. And then it starts coming down and you see a dip around 400. So you buy at 400 and then it drops down to 330. It's not, so you paid more because you bought on what you thought was a dip and you didn't want to miss out. You end up losing money if your timing is off, if your numbers are off, if your guess is off, and you can't know ahead of time what the stock is going to do in the future. It's foolish to think you can predict the future. If you think you can predict the future, God bless. I'm not that good. This scenario I'm showing here is where you really miss out. You set a threshold. I think when you're doing this, I'm going to sell on the peaks and buy on the dips. I'm going to sell on the way up and buy when it's at the bottom. You can set targets for yourself. Like, you know what? I'm going to sell at 400. So it's going up the mountain. You sell at 400 and you say, you know, I'm going to buy again on the dip. I'm going to buy at 300. And it never reaches 300 again. And you're out of the game. And now today it's at 620 or something like that last time I looked. You could have gone from 400 to 620 instead of you sold at 400 and you missed that additional 50% gain. It's a very, very difficult thing to do this timing thing. You'd like to think, well, I'm just going to buy at the peak and I'm going to sell on the dip, but you don't know whether you're at a peak when you're at the peak. You don't know whether you're at a peak when you're not at the peak. You don't know where the dips are. You can't know that because you would have to know the future, and we're not capable of that. This graph here is the last 5 days. It's gone from 400 to now up to 620. Well, where was the point where you should have sold? How do you decide where, you know, it's going up, it's going up, it's going up. Where's the right selling point? Where's the peak? Right now, we're rising. Right at this moment, the last time I checked, just a few minutes before I started making this video, it's going up. It's at 620. Do I sell at 620? You know, do I sell at 630? Where's my threshold? Is there a date that you're targeting? Is it the December 18th inclusion point? Well, is it really going to stop going up at that point? It's very, very hard to predict these things. I think it's some people think it's easy and it's not. And this is a unicorn event. This is a black swan or a unicorn event. This is a one-shot thing that doesn't happen very. We've never seen a company this large go into the S&P 500. So relying on, well, when this company was in the S&P 500, this is what happened, is really big gambling, because you don't know that the same things are going to happen this time. It's a different stock. Things happen differently. What I believe as a buy and hold investor is you buy whenever you're ready to buy, and you hold it for the long term, 5 years, 10 years, and you don't worry about short-term games like this. Something else to talk about when you're playing the short-term strategies is there are increased transactions costs. Now, most stock trades don't cost that much. You might be paying $5 or $10 for a transaction. If you're buying $100,000 worth of stock, that $5 is a blip. Even if you're buying $10,000 in stock, that $5 is a blip. But if you're trading $10,000 in shares at a time, and you do it frequently, it does start to add up. If you're trading every 3 or 4 days and you spend $5 here and $5 there, and some people are trading multiple times a day, this is one of the traps that short-term trading can get you into, is you increase your transaction costs, and that cuts into your gains, if you have gains. And then you have this, so there's two problems. One, you don't really know when the peak is, you don't really know when the dip is. And if you play these games a lot, you increase your transaction costs. If you buy and hold, you gain on all of that. If you believe the stock is going to rise over the long term, which is, I think it's much easier to predict long-term outcomes than it is to predict day-to-day or hour-by-hour pricing. The stock market fluctuates. It's highly volatile. Tesla is a particularly volatile stock. You might think, hey, at 600 is the peak, I'm going to sell now, and then it goes to 700. You might think after it peaks at 600, it's going to drop to 400, and then it hits 700, and it comes down to 650, and it never drops. Very, very hard to predict these things. Another thing is this S&P 500 inclusion is adding a large group of buyers who are going to hold. There's fewer people available willing to sell their stock after the S&P 500 index funds buy, and you've got funds that benchmark themselves against the S&P 500 that are also going to buy, and they're probably going to hold because they don't want to be too far off the S&P 500 or they lose investors. So you're creating this whole new class. You've got Elon isn't selling a share. Nuts like me aren't selling a share. Then you've got these index funds and other funds who are buying in, who are going to hold, and you're just creating a smaller class of people who are willing to sell. And with the price going up, there could be increased interest in the stock, and more people come in to buy thinking you're on this, tulip. You can end up with a tulip bulb, spectacle where it just goes up and up and up. And, I want to be clear, long run, I think $600, $700 a share is cheap. I think the stock is going to $10,000 a share. I think it might go to $40, $50, $100,000 a share going out 10 plus years. And if I'm right, and the stock is going to $50,000 a share in 2030, $40,000 a share, $50,000 a share, whatever, even at $10,000 a share in 2030, which I think is pessimistic, but a lot of people think it's crazy. But if you think it's going to $10,000 a share in 2030, then any reasonable discounting would say the stock is worth like $2,500 or more right now. If you believe that the true value of the stock is $2,500 today, or $5,000 today, or $10,000 today, then playing these games creates the potential that you miss out on the gains by holding. And that is a really important thing not to forget. I always think I'm right. We always think we're right at that moment, but we have to remember we're generally wrong, and our goal is to be less wrong. Check out my merch, link below. I made a video talking about one reason why the share price might go to $40,000 a share in 2030. I've made some other videos that talk about potential share price gains. Check those out to see the long-term prospects. Please support this channel on Patreon, join the channel on YouTube, subscribe, and thank you for watching.